One of the biggest corporate bets on Bitcoin ever assembled just fell apart practically overnight, and the founder who built it is walking out the door. Jack Mallers, the head of the payments company Strike, has stepped down from 21 Capital, a firm created to hold Bitcoin at massive scale. At the same time, an ambitious plan backed by the stablecoin giant Tether to combine 3 separate Bitcoin companies into that single vehicle has officially collapsed. 21 Capital was meant to become one of the largest public holders of Bitcoin anywhere on the planet, standing alongside the company that pioneered the strategy, Michael Saylor's strategy. Investors reacted fast, and the company's stock, which trades under the ticker XXI, dropped nearly 18% on the news. It is a rare stumble for the corporate treasury trend that has spent the last 2 years quietly hoovering up Bitcoin, and a sharp reminder that even these mega deals can unravel as fast as they were stitched together. The most important crypto law in America is stuck, and the thing holding it up has almost nothing to do with crypto itself. The Clarity Act, the sweeping bill that would finally set the rules of the road for digital assets across the United States, has stalled out in Congress. The single sticking point is one ethics section, the part that decides who gets to enforce conflict of interest rules on senior government officials. Democrats are balking at a version of that language tied to the Trump administration, and without a compromise, the entire bill stays frozen in place. If lawmakers cannot reach an agreement soon, a floor vote could slip past the August recess, pushing any final decision months further down the road. Supporters had hoped to push the bill across the line before Congress leaves town for the summer break. For an industry that has begged Washington for clear rules for the better part of a decade, watching the finish line move over a single clause about ethics is a familiar and bitter frustration. The app that taught millions of people to trade stocks is quietly pushing those same users toward the deep end of crypto. eToro, the retail brokerage with tens of millions of accounts around the world, has taken a strategic stake in Extended, an exchange built for on-chain perpetual futures. Perpetual futures are leveraged bets on where a price is heading that live entirely on a blockchain, a corner of the market usually reserved for hardcore crypto traders rather than everyday mainstream investors. eToro also said the deal kicks off a partnership with Zengo, the self-custody wallet it acquired earlier this year. Self-custody means users hold their own keys, instead of trusting a company to guard their coins for them. Neither side disclosed how much money actually changed hands in the deal. But the direction of travel is unmistakable, as a household name broker with mainstream reach nudges ordinary users toward on-chain trading and toward holding their own funds directly. Subscribe now!